can the shift of like the SML line be like a change in the slope?
A shift in the SML line. Okay, we're not going to go there. Is that Isabella? We're not going to shift it.
Yeah, but like if it goes like
Well, if
how
it's
you
a
were
shift
explaining.
to, okay, no, well, let me stick with this. We'll get back. I don't know if we need to get back there, but no, we're going to stick with the non-shifting SML line right now. But that's a good question. Okay, so no, we're going to just talk about being on the line. You can create any position on the line by choosing a combination of the risk-free and the market portfolio, either by purchasing T-bills or by short selling T-bills. The other, because of this relationship we have created, we can also use the line to estimate returns on the expected return on any security, stock or bond. Um, and we can do that as long as we have information about the T-bill rate, and there's only one, and we have the capital asset pricing model assumptions are in place. We have the information, and we can estimate the market portfolio's return, and we have information and we can estimate the beta of that stock. What do we need to calculate the beta? Do you guys remember? What's the beta made out of?
Don't you need the correlation and the deviation,
So
standard
there were
deviation?
three or at least two formulas I showed you, right? So beta, or if you guys ever are in despair, remember the simpler way of writing it, RSY over SX, right? And so it's going to be covariant correlation and then the two standard deviations. So we can write that with the betas. The betas is equal to correlation and then sigma over sigma. So what's y, SY? What's y? On the y-axis is the stock, and on the x-axis is the market portfolio. So this is our beta formula. So we need the correlation, which is the covariance and the standard deviations, and those are the standard deviations. So you need the covariance and the standard deviations to calculate the beta. The covariance of what? The stock's returns and the market returns. That's what you need, okay? So you need the information to calculate the covariances and the standard deviations, which you guys can do with your calculator very efficiently. If we have some time, we're going to get to the next set of notes and I'm going to outline it. And you guys practice for next class, prepare for next class, solving that problem, and we're going to go through it together. Basically, you just can do that in your calculator. And right, because you can get the
But do
slope out
we
of your
get the,
calculator.
sorry, Professor, I got a bit confused. Do we get the covariance or the correlation?
You can get the slope. Remember our calculator just gave us the slope? As long as we have the data for stock and the market portfolio, we can get the slope out of our calculator. The calculator would give us all these other statistics too, but we can also get the slope out of the calculator. So it's very easy. It looks intimidating with all the data and all the calculations, but if you use your calculators you invested in, you're going to get the slope in moments. Okay? So you'll see that. All right, so that's why we did all that. We spent that time on the statistics before, so you guys have that. But don't forget what we learned. That's all useful now. Okay, so you can get the slope right out of your calculator. But don't forget the formula. You need that. You need formulas. You need to know how to use your calculator. You need to know how to write things down. Okay, so what I was saying is that all stocks and bonds are on this line. All projects are on this line. It's going to help you determine the expected return in efficient markets. So, if that's the case, then there should not be any assets off the line. The assets back here that are on the line are assets with a negative beta, right? Because this goes negative. What assets are going to have a negative beta? What does a negative beta mean? And let's go back again to the definition of the beta. Beta
Wouldn't
is
it
the
be,
sensitivity of an asset returns to market returns. So if an asset, if an asset's returns are negatively correlated with market returns, they will have a negative beta. So what's a sector of the economy that's negatively correlated with the market? What's historically, if you guys know, when times are bad, when things are rough, when there's war, when there's um, tariff wars, when there's actually um, when there are international disputes, when there are problems, what tends to happen historically is that people turn to precious metals. They turn to gold, for instance, or silver, and that's where they put their money as a store of value. Okay? So precious metals are the classic, and precious metals, not just precious metals themselves, because that's not a stock, right? Companies that do mining extraction, companies that create securities in companies that extract, companies that have exchanges for precious metals, companies that store precious metals. Okay, so anything to do with precious metals, those kinds of companies in that sector would tend to have a negative beta historically. Now we're in kind of a different environment with cryptocurrency. That's where people seem to be tending to go. So in recent years, gold hasn't, with COVID, you didn't see people jumping on precious metals as much because they turned to cryptocurrency. But now you see sort of a correction happening. Anyway, without getting into current events too much, historically, it's like precious metals are here, or precious metal companies. You can get exchange traded funds that combine precious metals and precious metal extraction companies, mining firms, and things. Okay. So precious metals are here. Precious metals, precious metal. Okay, so that's just an example. So that could go here. So all the stocks are here. So what happens if a stock is off the security market line, or an asset is off the security market line? We're going to talk about that. This might not be clear, but you guys can review it because I'm recording it, and you also have the recordings that I've put into Moodle already. So what I'm going to do, I really don't want to erase this, but okay, I need to erase this. I'm going to take a picture and clean up this screen. Are you ready? Still there?
yeah,
Okay, so let's say there's a security over here. I'm going to call it security J. Security J is over here. It's not on the line. What's wrong with that? Why should it end up on the line? Let's see. For this level, oops, jumped. Hold on. Something happened. Let me clean this. So for this level of risk, investors holding J receive this level of return. Sorry. They have, for this level of risk, investors, so this is beta for J, and they have this level of return, okay? This is ER. Okay, so they have that level of return. But for this level of risk, investors at large can create this level of return. How do they create that? So if somebody has this level of risk, they could be here by borrowing, short selling T-bills and investing in the market portfolio. They could be here and have this expected return to compensate for this level of risk. What this model says is, over and above the risk-free rate, anybody invested in stock I will expect to be compensated by the market risk premium for every unit of beta. So if their beta is more than 1, they're going to get more than the risk premium, the market risk premium. Okay, so this is a markup above the risk-free rate. That's why it goes up like this. So if you have this level of risk, you can just create this level of return. Why would you invest in J? So in an instant, if you realize while you're holding J that, wait a second, this is a high level of risk, I could get this level of return, what would you do with J if you were holding J? And we'll assume it's easy enough to trade that transactions costs are negligible. You would sell J. And everybody holding J would sell J. But who's going to buy J on the other side? Because the people on the other side also see this discrepancy that they should, for this level of risk, investors could have this level of return by doing what I described. So the only way that somebody holding J can sell J is to offer it at lower prices. And then the subsequent person trying to sell it is going to have to offer even a lower price to incentivize buyers to take it. So what's going to happen? We're going to go here and look. As the price of J drops because of lower and lower prices, and assuming that the dividend remains constant, how can this equation be, how can we realize this relationship in this equation is that the expected return must rise. So that's what you see here. This is the adjustment, and it's instantaneous and efficient market. It's the realization that J is off the security market line, that this can be acquired instead. So people will sell J to invest by taking this position, and it would be at increasing lower prices. As a consequence of the price drop, the expected return is rising. So they expect higher and higher return, and it will adjust here as the price drops. So what we say are that assets below the line, what's a fancy way of, well, a simple term to capture what I've just described? The securities below the line are currently overvalued. They need to adjust. And as an overvalued security, it will adjust so that it equates this, what we understand the relationship in the valuation as the expected return rises, we end up right up at the line. Okay, so the price will drop. Expected return rises. It was initially overvalued. What about stock or assets that are above the line? Oh, sorry, I'm going to use a different color. What about this asset K? For that level of risk, investors are mixing evenly T-bills in the market portfolio. But if K exists and information about K is available to determine that the expected return is much higher, what will investors do? So you have the two sides. You have the traditional investors here, and then you have this people holding K. What would the investors here do? The opposite of what happened with J. They will acknowledge, they'll recognize, because they can do all these calculations as well, another assumption, and that a standard assumption is we can all make these calculations and see that K is currently undervalued. And they'll rush to buy K. And the first investors buying K initially will get a price for it. I want to erase this because I want to use this again. Oh, actually, I'll just draw it again. Well, it's the same relationship, so maybe so they get a price for it, but then the next ones trying to buy it will have to offer increasingly higher prices for it, right? So the price is going to be bid up. As a result of the price being bid up, to maintain this relationship, the expected return will drop to just here. So investors currently here either will trade off their position in the market, in the risk-free in the market portfolio, and buy K, and they'll realize the price rise as it goes back to the security market line. Okay, so undervalued stocks should be purchased and held to realize a price adjustment or correction. So these are investors should what we call long purchase and hold the asset, while overvalued stocks should be the opposite, shorted. Investors should borrow them and then return them to brokers when the price has fallen. Okay, so these are the price adjustments that will occur to reinforce the fact that all securities, bonds and stocks and investment opportunities are all on the security market line. All right, so I'll let you go. It's 12:20. Thank you for participating. If that was kind of weird, I'm going to post this up. If that wasn't clear, you can watch it again. You also have the videos that I explain this in, and it is clear some of you guys have already studied, and I really appreciate that. So keep it up. We'll talk again on Wednesday. Gabriela will show up with the papers, if not Gabriela, Francette. You can pick up your documents. And if you have any questions about anything, we can talk on Thursday. We can have a review class if you want. Friday night is the test. I'll give you the details for that in the days to come. Have a good afternoon. Gabriella, stick around.
Yeah.